If you run rent-to-rent or serviced accommodation, the tax rules are different from traditional landlords, and many operators get this wrong. Some think they don't need to declare anything because they don't own the property. Others mix up VAT, income rules, and allowable expenses. In this video, I'll explain exactly what income you must declare, what you can claim, how VAT works, how losses work, and the mistakes HMRC now focus on. Let's break it down simply. Hello, welcome to today's video. My name is Dora. I'm a chartered certified accountant and fellow tax advisor here at Grace Certified Accountants. Now, before we continue, can I ask you to please subscribe to our channel for more property tax tips and advice? And if you know of other people that you think will find this information useful, please share with them. Thank you so much. Now let's dive in. First, how rent-to-rent works. You rent a property from the owner at a fixed rate. You then sublet it to guests or tenants. From HMRC's perspective, this is a property business or trading business, even if you don't own the property. So, it's taxable. Your taxable income is the money you receive from guests or tenants minus your allowable costs. Next, what you must declare. HMRC expects you to declare guest income from Airbnb, Booking.com, etc., rent paid by AST tenants, that is assured short hold tenancies, guaranteed rent or commission, cleaning fees, linen charges, deposits kept, overseas platform income, for example, Airbnb Ireland, Booking Netherlands, Stripe USA. Ownership doesn't matter. The activity creates taxable income. And now, the allowable expenses for rent-to-rent. Fully allowable, rent you pay to the owner, utilities and council tax if you pay them, cleaning, laundry, linen and consumables, repairs, furniture. Companies only can claim capital allowances, booking platform fees, insurance, travel, staff and VA costs, and accountancy fees. And now, the expenses HMRC will reject. So not allowable, capital upgrades or refurbishments, owner's mortgage payments, initial furnishing, personal spending, non-protective clothing, fines, deposits that must be returned. Now let's look at the VAT rules. This is very important. Serviced accommodation equals standard rate 20%. You may need to register for VAT once turnover exceeds 90,000. Normal tenancies, for example ASTs, they are exempt, so no VAT. Mixed use models need careful handling. Now let's look at how losses work. Losses arise when the rent to the landlord is high, bills are high, occupancy drops, cleaning or linen costs spike. Losses can be carried forward against future R2R profits only. You cannot offset them against salary, dividends, or other businesses. So, what is this HMRC crackdown? HMRC now receive data from Airbnb, Booking.com, Stripe and PayPal, local councils, licensing schemes, insurance and contractor placement agencies. If your declared income doesn't match platform data or bank deposits, they will open a compliance check. Rent to rent can be profitable, but only when you understand the tax rules properly. HMRC are focusing heavily on this sector, so it's important to declare income correctly, understand VAT, and keep records clean. If you'd like help reviewing your rent-to-rent setup, you can contact me in the link below. I'm Dora from Grace Certified Accountants. Please remember to like, share, and subscribe to our channel for more property tax tips and advice. Thank you so much for watching. I'll see you again soon.